Hello, this is John Kicklighter, Global Head of Content for StoneX, here to discuss market conditions into next week and the top event risks that global investors will likely focus on. Now, in terms of the overall conditions, we are certainly leading into those circumstances in which we have that Santa Claus rally expectation. It comes with a lot of assumption and a very significant influence on how the markets are going to react to event risk, their capacity to actually establish trend or what a lot of traders look for, major reversals, and generally the cadence and camber of the market. So we need to be thinking first and foremost about that liquidity factor and consider that the impact potential is much lower, meaning it's going to take a much bigger surprise or something that is completely off the docket to generally get the kind of market movement that we would expect during more liquid periods of the year. So after the passing of the FOMC rate decision this past week, which rendered a lot less impact than I had expected, and I think a lot of others had expected, either risk on or risk off, it now is very much in the hold of those seasonal expectations. Now we're heading into the 51st week of the year, so we're coming into the very end, the final week before we have the holiday period, and that does carry with it expectations of an increase in volume, if you look at the S&P 500 averaged out over the past 75 years, but it also has a measured activity in terms of volatility, and for a benchmark like the S&P 500, it's usually a bullish, but albeit mild bullish move. Now, momentum to the upside, even if it is a return or restoration of an existing trend, bullish in risk assets, it's probably going to be significantly slower. It's going to be something of a grind, a crawl, and the capacity to mount a more systemic and aggressive risk aversion is going to be, again, a higher barrier. So if you're looking for bearish markets and you're very skeptical of the grind higher that we've seen in benchmarks like U.S. equity indices or carry trade or high yield fixed income and other risk-oriented assets, you really need to be looking for something that is out of the ordinary. So it's not something that's typically going to be on the docket. Now, in terms of the markets I'll be focusing on, I'll be watching all these benchmarks because I want to see that the markets are indeed conforming to those seasonal norms. However, I'm also going to be looking a little bit more closely at the more internal measures of sentiment. So instead of just watching, let's say, the NASDAQ 100, where there's a lot of that concentration of the mega cap tech stocks, I'll be watching the NASDAQ 100 versus the Dow Jones Industrial Average, so that ratio, or something like the S&P 500 versus the RSP, which is the equally weighted S&P 500 ETF, to see if there's that rebalancing of the concentration trade. Now, not a very momentous move, more likely than not, but it is a redistribution of sentiment in these lower liquidity conditions. And of course, I'll be watching the US dollar, which is moving back into a range, a more comfortable position. Something like the S&P 500, which if it would have pulled back, would have been pulled back into a broader range. Instead, it's kind of anchored there to the top end of the range. It's going to struggle. But the dollar moving back into an open technical range is probably going to have a little easier time moving, especially because we have event risk that's going to be meaningful in this upcoming week. And if you want to look for something that has volatility oriented to it, there's not a lot of options, but definitely silver is at the top of that list. Now, in terms of themes, this is the final full week of trade this year. So we do have a little bit of a theme in the outlier area. So we have the revival of another government shutdown risk in the United States with the failure of passing a replacement for the ACA. So that's going to be moved out, I think, a little into 2026. Of course, that the funding ends in around January 31st. But for the meantime, we will be looking more at monetary policy as a theme because we do have the Bank of England, the ECB, the BOJ, the People's Bank of China, and the Mexican Central Bank. And actually, quite a few of those central banks are expected to move their benchmarks. So that's going to be worth watching. Now, through all of this, though, we do have themes. We're going to have event risk that taps into economic activity. We're going to have event risk that taps into those underlying more traditional global macro issues. But their ability to move the markets is really dependent upon liquidity and these seasonal influences. So put that into context. But if we're going through the event risk, it's a pretty loaded docket, getting it out all before the end of the year. On Monday, I'll be watching the Chinese run of data. So we're getting the fixed direct investment, industrial production, housing prices, and other key readings for the month. Canada will have inflation, the CPI, which would be interesting for the next PBOC decision. And the US will have the housing market index, the NAHB puts out. On Tuesday, PMIs. So this is your final growth update for the end of the year. It's very timely. It's very comprehensive and a good proxy for general economic activity where it's otherwise very delayed to getting the official government readings or waiting for the IMF for the consistency. So that's worth watching. The UK has jobs figures, maybe a little volatility from that, but really the focus on the day is going to be on the very delayed U.S. non-farm payrolls. We are not going to see the October figures. Those have been canceled, but now we're going to be looking at the November figures. And we have a lot of proxy data that we can draw from, like the ADP payrolls and Challenger job reports and the like. But this is going to be of great interest, probably not necessarily as much to monetary policy after the FOMC decision and the guidance they gave us last week, but it'll be more about a reflection of economic activity and the health of the world's largest economy. On Wednesday, we have UK inflation figures, which are going to be interesting for BOE expectations, but obviously not for this week because we actually have the rate decision the next day. German business confidence and actually a liquidity consideration, the IMM, which is going to be the expiration of the quarterly money market derivative assets, which actually has quite a significant influence in the derivatives world and can trigger some interesting liquidity moves. On Thursday, we're going to get Canadian business confidence, CFIB, but I think we're really going to be watching central bank decisions and the US CPI, the CPI update. Now, this is also going to be a more recent inflation figure, having canceled the October reading, given its data collection issues after the government shutdown. This is going to be interesting as well. But again, like non-farm payrolls, I don't think it's going to really impact us that much in monetary policy until the next rate decision, and that one doesn't really carry with it much anticipation. More important on Thursday is probably going to be the Bank of England, the ECB, and the Mexican Central Bank. The Bank of England is actually expected to cut rates, the ECB is expected to hold, and the Mexican Central Bank is actually expected to change rates as well. So there is some very significant monetary policy outside of the norm of the Fed or the influence of the Fed, but collectively a very important group of monetary policy decisions. And then on Friday, we're going to have the Bank of Japan rate decision. The long-standing zero or negative interest rate central bank over the past couple decades is going to, or is expected to, hike rates by 25 basis points. It continues to move against the flow of its major counterparts. And this is very unusual and upending in terms of what it means for the exchange rates, because we see benchmarks like the dollar-yen truly moving against the flow of its expectations of yield differentials. That's going to be one to watch fairly closely. And then we're also going to have the Russian central bank with an expected move, and we're going to have the quad witching, which is derivatives multi-asset expiration date, which again is a very big liquidity influence. That wraps up the week ahead. Don't forget to like and subscribe for more financial market insights.